Hello, and a massive welcome to the Data Genius podcast.
It is so great to be here.
I am just thrilled you're joining us for this deep dive today. We are unpacking something huge today, a massive, basically invisible revolution that is completely rewiring corporate finance and accounting right now in 2026.
Yeah, invisible to the public maybe, but if you work in finance, it is very visible
Yeah.
and very loud.
Right, exactly. So for you listening, whether you're a CFO trying to modernize your tech stack without ending up in federal prison, or an IT leader, or just someone who is insanely curious about how AI is functioning in the real world, you are going to get so much out of this.
We have a really fascinating stack of sources to go through too.
We do. We are pulling from industry reports, technical blueprints, and ROI frameworks from places like Receipts AI, CodeBridge, Unit 21, Nominal, and a bunch of others.
And the mission here is really just to cut completely through the marketing hype.
Yes. No dense financial jargon without a plain English explanation. That is my promise to you today. So I want you to sit back, think about your own workplace processes, your chaotic inbox, and let's get into this. Because, when you close your eyes and picture a corporate accounting department, you don't typically imagine edge-of-your-seat technological disruption.
No, definitely not. You picture quiet rooms, cubicles.
Dual monitors full of spreadsheets.
Exactly. It's built on rigid predictability. Every fraction of a cent gets put into its proper little box.
It's supposed to be entirely structured, right?
Right. For centuries, literally going back to Renaissance bookkeeping, we demanded that our financial data be touched by human hands. We wanted a real person to look at the math and sign their name to it. Accountability was fundamentally tied to a human being.
Which is why the reality of 2026 is so jarring. If you step into a corporate finance world today, that quiet room is completely empty, the desks are cleared out.
The dual monitors are powered down.
Yeah, and yet the enterprise systems are doing their own math. They are finding errors, investigating them, and fixing them. It feels like science fiction.
It is a total paradigm shift.
Yeah.
We aren't just giving accountants faster calculators anymore. We are literally handing the keys over to autonomous systems. We are trusting software to make binding financial decisions.
And to understand why this digital takeover is happening right now, we have to look at the raw demographics. Because, the numbers in these reports are frankly shocking. Let me throw this statistic out there. The U.S. accounting profession has lost over a third of its licensed workforce since 2019.
It's just a massive brain drain.
Over 340,000 fewer accountants working today than 7 years ago. A third of the entire talent pool just vanished. How does an industry even survive that?
Honestly, it caught the corporate world off guard, even though, the warning signs were flashing for a decade.
Right.
It's a perfect storm. The primary driver is generational. Baby boomers make up roughly 75% of all CPAs.
Wow, 75%.
Yeah. And for the last few years, we've watched this systemic retirement of that generation. Between 2020 and 2022 alone, about 300,000 accountants and auditors exited permanently.
They took the gold watches, hit the golf course, and took decades of institutional knowledge with them.
Exactly.
But usually, a company survives that by bringing up the junior associates, right?
No,
A fresh crop of college graduates takes the entry-level seats.
they do. But the sources show the pipeline at the bottom has completely dried up. The replacement rate collapsed.
So students just aren't studying it anymore.
Right. The National Student Clearinghouse data shows accounting degrees hit a 20-year low.
Wow.
We are seeing a 30% drop from the peak back in the 2014 to 2015 academic year.
That is wild.
It gets worse. The Bureau of Labor Statistics projected over 124,000 annual accounting job openings, but universities are only awarding about 55,000 degrees a year.
The math is fundamentally broken, but why the drop? Accounting was always pitched as the ultimate safe career. You get your CPA, you get great job security. Why turn your back on that?
Well, it comes down to cost benefit. To even sit for the CPA exam, you need 150 college credit hours. That is basically a 5-year degree.
So an extra year of tuition.
An extra year of tuition, an extra year out of the workforce. And then you get an entry-level role where you work 70 to 80 hours a week doing tedious data entry during busy season.
Right, that sounds miserable.
Yeah, and they look at their peers doing data science or software engineering in 4 years, starting at a higher salary with better work-life balance. The appeal of traditional accounting just disintegrates.
That makes total sense, and the impact on businesses is staggering. The report shows 61% of hiring managers in finance say finding skilled candidates is way harder now.
A search for an accounting manager that used to take 6 weeks Now it takes nearly 10 weeks.
And that bleeds cash. Every extra week, a desk sits empty, costs between $3,000 and $5,000 in lost productivity.
So when you combine the retirements, the shrinking graduate pool, and the cost of open headcounts,
Yeah.
you realize this shortage is the catalyst for AI in finance.
Right. Okay, let's unpack this with an analogy because I think it helps visualize the scale. Sounds like the industry was trying to harvest a massive farm with hand tools, but the farm hands were all retiring and young people didn't want the job.
So the crops are rotting.
Exactly. So AI isn't some malicious threat coming to steal jobs. It's just the arrival of the combine harvester. It's a heavy machine built to do the labor nobody else is left to do.
The combine harvester is a perfect analogy. It's a shift driven by pure survival. And the adoption numbers prove it. 98% of accounting professionals globally now report using AI in their daily workflows.
I have to pause on that. 98%. That's not early adoption.
No, that is total market saturation. It is oxygen for the industry now.
And the market size reflects that. It's valued at $10.87 billion right now, projected to hit $68.75 billion by 2031.
With a massive compound annual growth rate. And it's not just Fortune 500 companies, right? Mid-market companies are driving this aggressively because they feel the labor squeeze the hardest.
They can't afford bidding wars for the remaining CPAs.
Exactly. So they turn to automation just to keep the lights on.
I think we really need to highlight what this means for you, the listener, if you work anywhere near this field. Because it's not a doom and gloom story. There's a massive silver lining.
Oh, absolutely.
The sources say workers who actively develop AI skills are seeing a 56% wage premium over peers who don't.
56% is life-changing.
Right, and 86% say it reduces their burnout.
Because the cognitive tax of manual data entry is handed to the machine. Reconciliations that took 3 days now take 15 minutes.
Which shifts their identity from data processors to strategic advisors. They do the high context work that AI still can't do.
Which is a really important distinction about the type of AI we are talking about here.
Yes, because people still picture the ChatGPT interface from 2023 where you type a prompt and copy-paste the result. But the tech in 2026 is a completely different beast.
What's fascinating here is the leap from generative AI to agentic AI.
Okay, break that down for us.
Generative AI, which dominated a few years ago, is a reactive assistant. You ask a question, it generates text, but then it stops. It waits for the human to figure out the next step.
Like a golden retriever. Very smart, but only fetches when you throw the ball.
That's great, yeah. Agentic AI is a border collie actively managing the herd. It operates continuously within defined parameters.
So it doesn't wait for a prompt.
No. An agentic AI deployed in accounting doesn't just read a vendor invoice and summarize it. It parses the line items, connects to the database, and cross-references active contracts.
And if it finds an anomaly?
It investigates. It searches the email server to see if a human approved an exception. If not, it proactively drafts a journal entry, flags it for a manager, and can even email the supplier autonomously.
It executes a multi-step workflow without a human ever clicking a button to start it.
Exactly.
To make this totally concrete for everyone listening, I want to dive into a specific process called the three-way match. The code bridge documentation goes into incredible detail here, and it's the perfect illustration of agentic AI saving millions.
It really is.
But let's establish the baseline first. What exactly is a three-way match?
It's one of those foundational internal controls in corporate finance. Its entire reason for existing is fraud prevention.
To make sure we don't pay for something we didn't order.
Right. You need to collect and compare 3 distinct documents before money leaves the bank.
Document 1 is the purchase order, the PO. This is the authorization. The company saying, yes, we will buy 400 office chairs for $100 each.
Document 2 is the receiving record, the physical proof of delivery. The warehouse opens the boxes and logs what actually arrived. Because if they only shipped 390 chairs, the record notes 390.
And document 3 is the vendor invoice, the actual bill from the supplier.
So the three-way match is the painstaking manual process of cross-referencing these 3 documents. The accountant verifies 3 things. First, does the invoice match the PO price?
Checking what we authorized.
Second, does the invoice match the receiving record quantity?
Checking what they actually delivered.
And third, does the receiving record match the PO? Did they deliver what we asked for?
And when all the numbers align perfectly, it's a straight-through process. The bill gets paid. But the real world is messy, right?
This is where we hit the exception problem. Matching perfect documents is easy. The massive cost lies in handling exceptions when the documents disagree.
And the sources say about 18.4% of invoices generate an exception,
Almost 1 in 5 transactions is broken.
which is a huge volume. If you process 10,000 a month, 2,000 fail to match.
And every single one stops the automated payment machinery. A human accountant has to intervene. And it costs, on average, $9.84 to manually process one exception.
And takes an average of 8.2 days to resolve. Why does it cost $10 and take a week to fix a mismatch?
Because it requires forensic detective work. The accountant has to stop their other work, find the PO in the ERP system, hunt down the procurement manager.
Who is probably on vacation.
Usually, yes. Then they have to ask about price hikes,
Mm.
email the vendor, dig through email chains for amended contracts.
It sounds mind-numbing.
It is. Once they piece it together, they have to manually document it and force the payment through. It's incredibly expensive.
Enter the combine harvester. How does agentic AI fix the exception problem? Because the data shows it drops processing costs from $13.54 down to $2.98. That's a 78% reduction.
It achieves that by automating the investigation itself. Let's use the chair example. The agent sees the invoice is for $110, but the PO was for $100.
So it doesn't just throw it in a human's backlog.
No. First, it queries the vendor's master data file for pricing agreements. Then it seamlessly scans the corporate email server for correspondence over the last 90 days.
Oh, wow.
It uses natural language processing to understand an email saying, hey, aluminum costs are up, chairs are $110 now. And the manager replying, understood, proceed.
It is literally piecing together the corporate narrative to find out why the math broke.
Precisely. And if a vendor forgets to write the PO number on an invoice, the agent just searches open POs for that vendor within a 5% margin, finds the match, and links them.
Instead of a human spending 45 minutes hunting down files.
The agent does it in 3 seconds. It packages the discrepancy, the context, the proof of authorization, and a drafted resolution.
And just hands that neat little package to the human. The human is no longer playing detective, they're playing judge.
They just review the evidence and click approve. It drops cycle times from 8 days to a few hours.
Okay, I have to push back on this, though. If I am a CFO listening right now, my blood pressure is spiking.
I'm sure it is.
If this AI is autonomously pulling data, reading contracts, and drafting journal entries, who is watching it? How do I know it's not just hallucinating numbers to clear its queue?
That is the central tension of enterprise AI.
We've all seen ChatGPT confidently invent a legal precedent. In marketing, a hallucination is a quirky spark of creativity. In finance, it's a catastrophic SOX violation.
Exactly. For those outside finance, Sarbanes-Oxley means if your numbers are materially wrong, executives can face federal prison.
Zero tolerance for creative math.
Which is why the engineering blueprints focus so heavily on physically restraining these models. They build hard-coded barriers to force the AI to be boring, predictable, and factual.
Let's get into the mechanics of that. Taming the machine. The sources outline 4 specific safeguards for dealing with hallucinations, drift, and security cages. Walk us through the first one.
The first is temperature control.
Are we talking about server cooling fans?
No, in machine learning, temperature is a tunable parameter that dictates the randomness or creativity of the output.
Okay.
Large language models don't think. They calculate the statistical probability of the next word. If you say the sky is, blue might be 95% probable, gray 4%, neon 1%.
It ranks the words.
Right. High temperature tells the model to take a risk and pick the 3rd or 4th option sometimes. Great for writing a sci-fi story.
But creativity is the absolute enemy for a compliance agent.
You never want to taking a statistical risk with a decimal point. So engineers set the temperature parameter to 0.
Which forces deterministic execution.
Exactly. The same input produces the exact same output 100% of the time. It doesn't cure hallucinations entirely, but it ensures the model makes the exact same mistake every time, making it easy to debug.
So we want the most boring, unimaginative, hyper-literal accountant possible. Step 1, dial temperature to 0. What's step 2?
Context engineering. And this is different from prompt engineering. Prompt engineering is just tweaking the question you ask.
Right.
Context engineering is rigorously controlling the exact payload of data you feed the model before it answers.
How does that look in practice?
Let's say you want to verify an invoice against a 150-page master service agreement. An amateur just dumps the whole PDF into the AI's context window.
And that's bad.
Giving an LLM too much irrelevant data degrades its accuracy. It gets distracted by liability waivers and legal jargon that has nothing to do with pricing.
It's like handing a jury 10,000 pages and expecting them to find one specific sentence. They lose the forest for the trees.
With proper context engineering, a specialized algorithm first scans a contract, extracts only the pricing table on page 42, and hands only that table to the LLM.
You're engineering the worldview.
You severely restrict its view to highly relevant, verified data points. It drastically reduces the probability of hallucination.
It's digital micromanagement. Hand it a flashcard and say, does this match? I love that. Okay, what is safeguard number 3?
Evil sets. Evaluation sets is the testing gauntlet, a massive database of historical real-world transactions where the correct answer is already known because a human solved it in the past.
It's a brutal practice exam for the AI.
Built entirely of edge cases, not easy invoices, handwritten receipts from 1998, weird VAT tax anomalies from Germany.
And the AI has to pass this before going live.
It has to run all 50,000 transactions. If it fails on invoice 49,999, they halt deployment, dive into the logs, fix the logic, and run it all again. Near perfect accuracy is required.
That is massive rigor. Okay, so 0 temperature, restricted context, and a 50,000 question practice exam. Sounds bulletproof. But there's a 4th issue. Safety drift. What is drift?
Safety drift is terrifying. It's the gradual degradation of alignment during a long interaction.
How does that happen?
Imagine an agent deployed as a co-pilot. The engineer gives it a strict prompt. You are conservative, follow GAAP rules, never suggest tax evasion.
Makes sense.
On turn 1, it's highly accurate. But by turn 50, the context window is clogged with the ongoing conversation. The volume of back and forth mathematically outweighs the original safety instructions.
It drifts away from its anchor.
If the user asks aggressive hypotheticals on turn 45, the model might offer illegal financial advice just to be helpful.
That is deeply unsettling. It starts as a straight-laced auditor, and by 3 p.m., it's suggesting offshore shell companies. How do they prevent that?
Aggressive mechanical hooks. Forced context truncation is one. The system forces the model to digitally forget earlier parts of the conversation so memory doesn't overload.
What about the rule?
Programmatic reinjection. The software invisibly repastes the core safety rules into the prompt at every single turn, constantly reminding it of boundaries.
Wow, just hammering the rules into its head.
And they use secondary, smaller AI models just to monitor the main model's output. If the safety score drops, the secondary model triggers a hard stop.
Which brings us to perhaps the most brilliant concept in the sources. The Akeos case study outlines the security cage. If I'm handing over bank routing numbers and unreleased quarterly earnings, this is what I want. Break down the security cage.
It's a masterclass in policy as code. Historically, to have an LLM analyze the sensitive document, you'd send it via API to a third-party server like OpenAI.
Which gives chief information security officers absolute nightmares. You're sending corporate secrets over the internet to a black box.
Exactly. The Akeos system rejects that. They bring the model in, but put it in solitary confinement. When a document enters, the platform spins up an ephemeral, sandboxed environment.
The cage.
The cage. It exists only for the millisecond it takes to process that specific document.
And what happens inside?
Before the AI sees the document, a non-AI redaction engine sweeps it for PII social security numbers, routing numbers, and replaces them with synthetic tokens.
So a routing number becomes like bracket bank routing token 1 bracket.
Yes, the original data stays safely outside. Then the LLM boots up inside the cage to analyze the scrubbed document.
But they still don't trust it.
Not at all. The cage has zero network access. The digital Ethernet cable is cut. It cannot query the internet or send an email.
And there's a financial kill switch, right?
A hard budget of 25 cents per document. If the AI gets confused and tries to burn compute power, the moment it hits 25 cents, the cage terminates the process.
It just pulls the plug. And after it's done successfully,
The AI passes the data back out, the redaction engine maps the tokens back to real numbers in the encrypted database, and the cage is irrevocably destroyed.
wow.
It just vanishes. No persistent state, no vector for data leakage.
If you're a terrified CFO, that is the pitch you want. Not a polite promise, but an engineer saying, or we built a blast chamber, stripped the data, cut the internet, and blew up the chamber when the math was done.
Verifiable safety.
But here's where we pivot. Even with all these safeguards, the industry insists humans must remain involved. The AI can't operate in a vacuum.
Right.
But the way vendors talk about human oversight is deeply flawed. Let's talk about audit theater and the illusion of human in the loop. Here's where it gets really interesting. Vendors tell CFOs, don't worry, a human reviews everything.
Which is often just a dangerous illusion.
Why does relying on a human reviewer fail as a governance strategy?
Picture the reality. At 4:55 p.m. on a Tuesday, an AI processes 500 invoices, it flags 50 for review, it presents a dashboard to an overworked AP manager trying to leave to pick up their
Oh,
kids.
I see where this is going.
If the software just says, I recommend approving these 50, the human is blind to the underlying logic. They can't see the database queries or historical context.
So what does the tired manager do?
They glance at the totals, assume the million-dollar software is right, and click Approve All.
They aren't providing oversight. They're just a liability shield for the vendor.
Exactly. By clicking Approve, that human legally absorbs all liability. If one invoice is fraudulent, the auditor blames the human. They carry 100% of the accountability with zero functional control.
That is the definition of audit theater. It's like blindly clicking, except on terms and conditions. So to fix this, we have to look at the spectrum of control. Break down the 3 levels for us.
Level 1 is in the loop, the most restrictive. A human must affirmatively sign off inside every decision cycle before action is finalized.
The AI prepares it, but is locked from executing.
Yes, essential for high-stakes, low-volume tasks, like a quarter-in revenue cutoff or a multi-million-dollar payment.
But if you do that for everything, you just turn your highly paid CPA into a full-time AI babysitter.
Which leads to level 2, on the loop. Designed for high-volume, repetitive workflows. The human doesn't review individual transactions. They set the guardrails at design time before the AI is turned on.
Like you can pay any top 50 vendor under $5,000 with less than 2% variance.
Exactly. The agent operates autonomously within those bounds. The human monitors dashboards and spot checks samples. They manage the system, not the transactions.
I love that. In the loop is hands on the steering wheel. On the loop is adaptive cruise control. What's level 3?
In command. Firm-level governance.
Mm.
Leadership deciding if AI is legally or ethically allowed to touch a workflow at all.
Drawing the hard boundary line.
Like allowing AI to sort audit documents, but strictly prohibiting it from drafting the final audit opinion letter.
Okay, so if we want real governance, we run into this logic puzzle highlighted in the numeric source, the AI documenting AI problem. Why do auditors hate this circular logic?
It's a massive vulnerability. If you need an audit trail to prove why a decision was made, and you ask the AI model that made the decision to write the log explaining it, you've created a huge conflict of interest.
It's like a student grading their own math test and writing an essay about why they deserve an A.
Yes, LLMs are designed to be convincing. They will hallucinate a highly plausible rationale for an incorrect action to justify their mistake.
So if an auditor reads a beautifully written AI paragraph, it's not valid evidence.
It's just a story the AI made up after the fact. Zero verifiability.
So how do you build an audit trail that survives a SOX audit?
Strict corroboration through deterministic system-level logging. The audit log cannot be generated by the AI model. It must be generated by the rigid software platform housing the AI.
The platform itself steps in.
It records immutable metadata, the timestamp down to the millisecond, user permissions, the specific version of the AI model used, and a cryptographic link back to the raw source data.
It's not a conversational summary. It's cold, hard data. Model V4 executed a script at 2:04 p.m. Input A was PO 123.
Exactly. And the most defensible way to implement this is forcing humans to set rules in natural language before the agent acts.
The accounting team writes procedures in plain English.
Yes. Flag any invoice where price variance exceeds 5%. The software converts that into a mathematical parameter. When reviewed, you're looking at the system's log of parameters met or failed, never relying on the AI's narrative story.
That distinction is everything. Mechanically generated evidence is auditable. AI chatbots reconstructing their memory is audit theater.
Absolutely.
This leads us seamlessly to the final question for any business leader. The economics. The ROI trap. Vendors claim AI will save a fortune, but CFOs are cynical. Why is it so hard to mathematically prove these tools save money?
It's difficult because IT teams measure the wrong metrics, ignore maintenance costs, and fall for phantom productivity.
Phantom productivity. I think everyone in a modern office has felt this. How does it destroy an ROI case?
Say you deploy a tool that saves your senior controller 10 hours a week on bank reconciliations. The vendor hands you a dashboard. The CEO applauds.
Looks great on a slide.
But you pay that controller a fixed salary. Your payroll costs didn't drop a single cent. The cash is still leaving the bank.
The controller isn't giving 25% of their salary back just because they finished their spreadsheets on Thursday.
Right. So what happens to those 10 hours? If management has no plan to redeploy them, human nature takes over. They spend 2 hours in non-essential meetings, 3 hours answering Slack messages, 5 hours formatting a spreadsheet nobody reads.
The corporate sponge absorbs the time.
You spent a fortune to buy back time and wasted it entirely. You saved $0. If you can't prove those hours generated new revenue or froze a planned headcount, it's just phantom productivity.
That is a brutal reality check. You have to capture the time and turn it into money. What is the second major trap? Completion rate versus outcome rate.
This separates veterans from amateurs. Completion rate is a technical metric. Did the AI finish the mechanical steps without a software error? Did it open the email, extract text, populate the database?
Which could be a 99% completion rate. Green lights everywhere.
But outcome rate is the only metric the business cares about. Did it actually solve the underlying problem without a human fixing it?
So if it extracts the data but gets one decimal point wrong.
The task is technically complete, but the outcome is a disaster. A human spends 20 minutes unwinding the journal entry and fixing the error.
Taking longer than if they just did it manually.
In that scenario, outcome rate is 0. A deployed agent might have 99% completion, but only 60% outcome rate. That 39% gap is where all your cost savings evaporate into manual rework.
Wow. If you aren't measuring outcome, you're flying blind. So how do we build an ROI framework that survives a finance audit? Walk us through the 5 steps.
Step 1. Establish a rock-solid baseline 30 to 60 days before you deploy the AI.
You can't prove improvement if you don't know where you started.
Right. You need unassailable metrics on current manual cost per transaction, error rates, and dedicated hours. Step 2. Define a strict 12-month measurement period.
Don't judge it on month 1.
No. The first quarter is burdened with integration costs and tuning. Efficiency actually drops at first. You need a full annual cycle.
That's step 3.
Layering the benefits into 3 tiers. Tier 1 is hard savings. Tangible dollars on the balance sheet. Canceled legacy software, terminated outsourced contracts, frozen headcounts.
Hard dollars. What's tier 2?
Soft savings, the hours saved by salaried employees. But only if you have a documented plan for how those hours are redeployed into measurable value.
Avoiding the phantom productivity trap.
Exactly. Tier 3 is strategic value. Better visibility, faster close cycles, highly valuable, but hard to quantify in dollars.
So don't build your core business case on tier 3.
Never. It's the cherry on top. Step 4 is tallying the costs honestly, not just the vendor's licensing fee, internal IT labor, API consumption costs, and the trust tax.
The trust tax. I love that term. What goes into it?
The ongoing cost of your evaluation infrastructure. Human QA time, engineers updating prompts when models like GPT-4 update unexpectedly. If you don't budget an extra 10 to 15% for ongoing maintenance, your model drifts and your ROI dies.
Trust isn't a one-time fee. It's a living thing. So step 5, what's the final metric?
The payback period. Subtract cost from Tier 1 and verified Tier 2 to find monthly savings. Divide initial investment by monthly savings to see how many months it takes to break even.
CFOs don't care about a vague 300% ROI percentage on a slide.
They want a timeline. If I write a $500,000 check in January, what month do we break even? A payback period under 6 months is exceptional. Under 12 is strong.
And if it takes 2 to 3 years?
Walk away. The tech evolves too rapidly. Any system deployed today will be obsolete in 36 months. It must pay for itself quickly.
That forces incredible discipline. Target a painful bottleneck, automate the investigation, put it in a security cage, and get your money back in 8 months. It's so practical.
It is deeply pragmatic.
Well, looking back at the journey we just took, it's remarkable. We started with a demographic crisis, 340,000 missing accountants, and saw how humanity is engineering its way out. You don't just plug a chatbot in. You build ephemeral security cages, zero out temperature for deterministic logic, and demand immutable audit trails.
It's a profound maturation of the technology. Finance is deeply conservative by design. This isn't reckless adoption. It is heavily guarded, skeptical automation.
Which leaves us with a deeply provocative thought as we wrap up. Think about the human being at the center. As AI becomes more autonomous, resolving exceptions and generating audit trails, how does the human job change?
It's a fundamental shift.
If the machine is doing the math, the human accountant is no longer a preparer of numbers. Will the role shift entirely to an auditor of AI logic?
I think so, yes.
Will future accounting degrees need to look more like computer science and prompt engineering degrees? Because if the AI is driving the combine harvester, your job isn't picking wheat anymore. It's maintaining and governing the machine.
The foundational expertise understanding gap, capital flow, risk remains crucial. The machine can't define risk, but the daily application moves from grueling execution to strategic governance.
It is wild to think what this industry will look like in 5 years. Well, that wraps up our deep dive into the AI accounting revolution of 2026.
It was a pleasure unpacking this with you.
Same here. If you got value out of this, please support the show by taking 3 quick actions. First, drop a like on this deep dive on whatever platform you're using. Second, leave a comment. We want to know if you think your company is ready for agentic AI or if it's still too risky for your ledger. And third, make sure you subscribe to the Data Genius podcast for future deep dives.
Much more to explore.
There really is. Usually, when we think of corporate accounting, we picture quiet rooms and endless spreadsheets. Today, we learned that the quiet room isn't something to fear. It just means the digital systems are finally doing the heavy lifting, and the human beings are finally free to do the actual thinking. Stay curious, keep learning, and here's to working smarter alongside our new digital colleagues.